Opening remarks. Over the past week, headlines have been dominated by a widening Iran conflict, volatile markets, and big shifts in corporate strategy and capital flows. I will walk you through each major topic in clear, listener-friendly language, preserving the essential points in detail. Topic 1. Iran war fallout and global ripple effects. A U.S.-Israeli strike on Iran has escalated the conflict, with the Trump administration calling the operation a 4-5-week short mission, while experts warn that a resilient Iranian regime could prolong the war, creating political pressure for the administration. Energy and logistics have been hit hard. The Strait of Hormuz disruptions and attacks prompted sharp oil price moves. Brent and WTI up, analysts flagging $84 to $100 scenarios. LNG production interruptions, including force majeure at Qatari facilities, and tanker freight and insurance spikes. Financial markets reacted with rising U.S. Treasury yields alongside equity sell-offs across Asia, Europe, and the U.S., and travel chaos has followed. Over 20,000 flights canceled and more than 1 million passengers affected, hitting hub airports like Dubai and tourism economies. The crisis also threatens remittances to countries such as India, roughly 3.5% of GDP, about $50 billion in flows, pressures European household energy bills, raises defense procurement demand, and raises concerns about Pentagon transparency and unrelated trade legal uncertainties that add to market unease. Topic 2. Markets and corporates reshaped by geopolitics, AI, and consumer shifts. Policy whiplash from sudden tariff moves. Trump raising temporary tariffs toward the legal 15% limit and a Supreme Court ruling clouding authority has injected fresh uncertainty into retail and supply chains, while Middle East and U.S.-China tensions add cost and demand risk for firms. China is shifting toward an industrial high-tech push for 2026, targeting semiconductor, aerospace, biotech, quantum, and embedded AI, with roughly 10% annual boosts to science budgets and a 7% defense budget increase, accelerating global tech competition. U.S. consumers remain cautious, so retailers are avoiding broad price hikes and focusing on sourcing diversification and margin protection. But analysts estimate tariff uncertainty could cost global firms roughly $210 to $229 billion in 2025 and about $150 billion in 2026. Company examples illustrate the strain. Abercrombie flags disruption and cost risk from conflict in shipping, and Adidas projects roughly $400 million profit pressure from U.S. tariffs and a weak dollar. Topic 3. Kevin-Warsh nominated to chair the Federal Reserve. President Trump has formally nominated Kevin-Warsh to be Fed chair and simultaneously sent a nomination for a 14-year term on the Board of Governors to the Senate. Warsh's confirmation will require a majority vote after Banking Committee review. Warsh served as a Fed governor from 2006 to 2011 as one of the youngest ever appointees, has Wall Street experience at Morgan Stanley and White House economic advisory experience under George W. Bush. He leans toward rate cuts, viewing inflation drivers as rooted mainly in fiscal and monetary policy rather than supply shocks, and supports shrinking the Fed's asset holdings to lower long-term rates. Although a Republican Senate majority improves his prospects, Senators Tom Tillis and Lisa Murkowski have signaled opposition pending resolution of DOJ investigations tied to the Fed building renovation. And if confirmation is delayed, Jerome Powell could remain as acting chair past May 15th under internal Fed arrangements. Topic 4. Active market repositioning. Private credit stress, Berkshire buybacks, AI funding surge. Private credit funds have faced large redemption waves that exposed liquidity mismatches. Blackstone's BCRED saw record redemptions of about 7.9%, $3.8 billion, leading the firm to raise its liquidity gate to 7% and absorb the remaining 0.9% internally, while other managers paused regular liquidity distributions or shifted to asset sale-driven payouts and saw stock weaken.